I now hand the pins over to Mr. Bharat Chhoda from ICICI Securities Limited. Thank you, and over to you, sir.
Thanks, Nirav. On behalf of ICICI Securities, let me welcome you all to the Q4FY21 earning call of Filatex India. From the management today, we have Mr. Madhusudan Bagheria, Chairman and Managing Director, Mr. Madhav Bagheria, Vice Chairman and CFO, Mr. Ashok Chauhan, Executive Director, and Ms. Tuti Bagheria, Senior VP Corporate Strategy. Without any further delay, I would now hand over the call to Mr. Madhusudan Bagheria for his initial comments, post which we'll open the floor for Q&A. Thank you, and over to you, sir.
Thank you. Good afternoon. A warm welcome to all of you attending this earning call for Q4 ended March 2021. I presume you would have certainly gone through the presentation, which have been uploaded on our website as well as on the stock exchanges. I am delighted to convey the exuberance in the market witnessed in Q3 continued for several weeks, almost through the next quarter. So this quarter under review has been more than extraordinary. If Q3 was extraordinary, then Q4 was stupendous. Let me quickly go through the results of this quarter, Q4 FY21. The revenue from operations are rupees 853 crores in this quarter as compared to 722 crores in Q3 FY21 and rupees 667 crores in Q4 FY20. In terms of aggregate revenue, the revenue for FY21 is rupees 2,227 crores as against 2,782 crores in FY20. Almost full capacity utilization of value-added products in this quarter has helped us achieve healthy operating profits. The EBITDA for this quarter is rupees 189 crores as against 120 crores in Q3 FY20 and rupees 62 crores in Q4 FY20. EBITDA for the whole year is rupees 347 crores, which is a 56% improvement over last year number of rupees 222 crores. The PBT for Q4 FY21 is 173 crores as against 91 crores in Q3 FY21 and rupees 32 crores in Q4 FY20. PBT for the year FY21 is rupees 240 crores, which is 96% jump over 122 crores in FY20. In the fourth quarter, the domestic demand for yarns was good, which is evident from the financial numbers. Prices and margins remain firm in the domestic market. Increase in duty rates on cheap imports of fabrics and garments had a curbing effect, which almost contributed to the firmness in the margins. The demand was robust as there was just about enough supply. Export market opportunities were also in plenty, but could not be encashed fully due to very erratic shipping schedules and rather steep hike in shipping rates. Fourth quarter was better than the third quarter, and that is saying a lot as the third quarter was quite good. It looked like a stable business environment with firm demand and good margins. However, we could feel the tremors of another calamity around mid-March 2021. The second wave of COVID gave rise to high positivity rate in Maharashtra and Gujarat. The downstream demand slowed down and inventory started increasing. We moved to Q1 FY22. As we move to Q1 FY22, there are concerns about adverse impact of a second tsunami type of wave of coronavirus, which is upsetting the rhythm of the industry. Once again, there is disruption of daily life in almost all parts of the country. Restrictive measures through containment of movement of people, goods and services, stricter protocols of quarantine measures have reduced the exuberance. There is an atmosphere of fear against this dreaded disease which gives little warning. Maharashtra and Gujarat, the major textile hubs for synthetic fibers, are some of the worst affected. The infection rate in this wave is much higher than the first one. The movement of traders and buyers is restricted. The workers who had returned are wary once again and fearing the repetition of hardships faced last time, have started going back to their villages. Government at state and center levels are trying their best to restore confidence in general public. India has gone through a massive vaccination drive. We have had a vaccination camps at our plants, and all eligible people, as per government criteria, have been vaccinated. However, the situation in grim and medical facilities are stretched beyond their limit and are breaking down. What we are witnessing in India is unprecedented, and no one knows how to beef up medical facilities. The effects of the total lockdown were very damaging to the economy, which led to a massive job loss situation. No one is keen on a repetition of the same. However, given the surge and creaking health infrastructure, it may be imposed again to control the surging rate. With prayers on our lips and hope in our hearts, we are ready for meeting any kind of disruption that may be imposed. We have reviewed our plant capacities and find that we can add some more POI, around 100 tons per day, and consequent texturizing capacity as a part of debottlenecking of semi-dull and bright lines. The plans have been finalized and discussions are on with equipment suppliers. The effect of stimulus through government policies for textile industry, in which polyester now plays a dominant part, is quite clear and has taken a visible shape. Our global competitiveness has also improved. On the export front, though there are good inquiries, the opportunity is not fully encashed as there is still shortage of containers and freight rates continue to be high. Despite these constraints, we managed to export 10,000 metric tons in this quarter compared to 12,000 in Q4FY20. We have been consistent in our assessment that polyester will be the dominant fiber and would lead the revival and resurgence of Indian textile industry in the global trade. In spite of the havoc caused by the second wave of the virus, we are sanguine about the growth of polyester business in the coming years. The government of India has realized the importance of textile industry in terms of job creations due to its innate nature. Textile businesses include apparel and garments is rather labor intensive, and skill sets are easily replicated to new entrants of workforce. Now the focus of government is not restricted to cotton only. Government of India has also realized and recognized the importance of synthetic filaments and fibers and is increasing role in global textile trade. The policies are being reviewed and modified to remove the hurdles for accelerated growth in fabrics and garments made from man-made fibers. Industry genuine demand for correcting the inverted GST structure for polyester fibers is still pending as government officials and GST council members are grappling with many other issues, the foremost being the containment of COVID. We remain optimistic for a favorable outcome as the concerned officials have been supportive to this subject in principle. Uniform GST rate across the whole value chain will accelerate the growth as well as benefit smaller units by easing stress on working capital. We believe the biggest benefit of one GST rate will boost the business prospects of downstream industry, which would lead to more investment in downstream products. Government has also announced production link incentive (PLI), in which man-made fiber garments are main recipients. Industry associations have represented inclusion of synthetic yarns, fibers and fabrics under these schemes. There are some signals about international sentiment against Chinese supplies. Opportunities arising out of such sentiments have to be grabbed quickly so that the prospect of polyester filament and fibers business in India could improve. Our captive power project of capacity 30 megawatt after facing delays due to national lockdown is back on rails. Commissioning activity, though somewhat hampered by COVID, have started. We are hopeful that we'll be able to commission the plant by May beginning. brief update on our R&D efforts on recycling project. I have had several opportunities to respond to questions about progress of recycling project and time schedule, etc. Let me take the opportunity to elaborate some of the very basic points about recycling polyester, generally referred to as PET, which is not biodegradable. As the volumes of plastic waste became visible in public places, beaches, tourist destinations, it caught attention of not only several international organizations monitoring the environment, but the public at large. Initial efforts of the industry was focused on collecting PET bottles, cleaning them, shredding them into flakes, which were melted and homogenized. Many plants came up and China became the key player in making fibers from waste bottles. Several plants came up in India also. Bottle collection started from rag pickers to scrap dealers became fairly organized. The bottle scrap has no intrinsic value unless there are units to process the scrap into a useful material. This process is called mechanical recycling. However, this step, though quite effective for bottle and container grade polyester, served a limited purpose as it does not address the utilization of textile waste. Among the two primary uses of PET polymer, the largest portion is consumed to make polyester textiles, the balance being solid-state resin and higher-grade engineering plastic. The approximate split between these major classes is 65% fiber and 35% solid-state resin. To get an idea about the volume of PET fiber, it is reported that PET fiber represent about 60% of all textile fibers produced globally, which was around 115 million tons in 2019. It is a fact that over last decade, the growth in consumption of textile fibers has mainly come through polyester only. The growth of all natural fibers has been less than 5%, whereas man-made fibers accounted for 95%. Polyester, due to its durability, ease of washing and maintenance, has replaced cotton and other natural fibers in many segments. Leisure wear, sports wear, lingerie, inner wears, home textiles, auto seats and covers, etc. The list is getting longer. Such rapid increase has necessitated the need to address the issue of textile grade polyester and its disposability or reutilization. Let me add, in terms of ecosystem, all textile fibers, whether natural or synthetic, though essential, create environmental issues like consuming water, polluting water streams, washing acts, microfibers which are now settling in oceans. However, polyester is a polymer of two hydrocarbon products and it can be chemically reversed, that is depolymerized. Many companies have experimented with this idea and there is a lot of study material available. It is only after the sustainability of textiles gathered momentum that recycling by way of reversing the polyester to virgin material has come back in focus. This process is called chemical recycling. A non-profit organization, Textile Exchange, challenged over 50 textile, apparel and retail companies, including giants like Adidas, H&M, Gap and IKEA, to increase the usage of recycled polyester up to 25%. As technology development is an expensive and time-consuming process, the retailers are willing to pay premium for all certified recycled fibers. Coming back to our R&D efforts, the lab trials were successful. A small pilot plant of around 50 kg per day has been made, which is being used for trials. Each process parameter has to be repeated many times to ensure that results would be the same when scaled up. Our efforts have been hampered in terms of getting specialized small size equipment from domestic vendors who are mostly located in Pune, Ahmedabad, Vadodara and some overseas vendors. And all these specialized vendors have suffered on account of restriction imposed for containment of COVID. If these local constraints continue to persist and cause delay in our efforts to freeze process parameters at the existing pilot plant, we will go for a larger capacity plant around 1 ton per day for further trials before going ahead with full-scale plant. I hope this clarifies some of the questions that you may have had about recycling. Thank you for your attentive listening. Now, let me open for a session for the questions. I would request that please ask 1 or 2 questions at a time. Once I answer them, then you can ask more. Don't ask too many questions in one go. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Sudhir Beda from Right Time Consultant Service. Please go ahead.
Good afternoon, sir, and hearty congratulations on stupendous set of numbers, healthy cash flow, as well as considerable reduction in debt. So all your entire team deserves congratulations.
Thank you.
Sir, my question is just one question. When you say that Q4 is some extraordinary, Q4 is an extraordinary quarter, so what kind of sustainable margin do you foresee in FY22? In view of our good saving will happen in power plant, as well as we will also do some expansion in value-added products. So what kind of sustainable margin do you foresee for 22? And what kind of debt reduction are you planning for the current financial year?
Thank you. See, barring the unordinary circumstances which we are going through, once these things comes to a decent level, I think the COVID situation improves. We feel we will be able to do margins which are better than Q3.
Good.
And we will also have an extra saving of roughly annualized around 45 crores in our power cost from this power plant which we are seeing. So these kind of margin we should be able to have once the situation of COVID is under control. See that during this situation, it's very difficult for anyone to tell what kind of margin we'll have if this situation prevails.
Yes, no. We are. I am asking just as a normal situation. Near to
normal situation, we will have margins which will be better than Q3, because in Q4 we also had some stock gains because there was quite a bit rise in the raw material prices. So there was a stock gain also which is being reflected in the margins. So we will have margins which will be much better than Q3 for sure. And over and above that, we will have savings of power.
Right.
That is what I foresee. And about debt, we think we should be able to reduce at least debt by 100 to 150 crores in this year.
Oh, great. That's a good news. And what kind of top line growth we expect in FY22?
FY22, see, FY21, if I take over that, we should be able to do more than 50%.
Oh, yeah. Great.
Yeah.
So thank you for giving me the opportunity.
Yeah.
Thank you. The next question is from the line of Agastya Dave from CAO Capital. Please go ahead.
Thank you very much for the opportunity, sir, and congratulations. I hope everyone is safe. Sir, one clarification. You said 50% growth, but I missed which year.
Sorry to interrupt you. May I request you to speak a little louder?
Yeah, can you hear me now?
Little better, yeah.
Yeah.
So, you mentioned 50% revenue growth. What was the base year?
So 50% revenue growth, I am talking about FY21 only.
Right.
On FY20, if we talk, then the growth could be around 25% to 30%.
Got it, sir. Got it. Sir, I have a query on spreads. in the current round of disruption, what has happened to the spreads? Have they completely tanked, or are they still at respectable levels?
No, they have definitely come down, but still we are making a reasonable EBITDA. I mean, we will be able to take out cost and have some profit. But we have to reduce also certain production also. Around 15% productivity we have reduced since last 3-4 days. Before that, we were almost running full. From last 4 days, we have reduced 50% production because the stocks are piling up. See, but the raw material prices are firm, so we don't mind increasing the stocks. As and when the situation improves, we will be able to sell those stocks.
Perfectly
we are
understandable,
on exports a little more to augment the local market.
Right. Sir, you mentioned 100 tons of POY in Brightline, which you can do by debottlenecking. So this is over and above the existing pre-announced Capex programs, right?
Yeah, this is a new Capex which we'll be taking. It's 100 tons of POY, which will be a mixture of bright and semi-dull both. And this will become operative by first quarter FY23.
Okay. And sir, hello.
Yeah.
So what would be the Capex for this?
For both, including POY and texturizing, the Capex would be around 175 crores.
Got it, sir. So one final question. This is on employee costs. You have controlled it for this year. And in my previous interaction with your company, the impression I get is that there will not be a disproportionate increase in employee costs going forward, even as we expand capacities. So you are still holding to that, sir?
I couldn't get which cost you are talking.
The employee costs.
Employees cost. Yeah, it will be disproportionate to the incremental cost. It will not be same, but see, there is some increment also you have to give every year. So, but the number of employees will be very not so much. We will be mostly having laborers. We will have to include, but on the senior management, we will not be increasing. That's the only difference. And also the administrative staff and remains same.
Right. Sir, 3 bookkeeping questions. The gross block, the fuel costs for the entire year, and the current maturity of long-term debt.
You want to know them? What is it?
Yes, sir. Gross block, fuel costs, and current maturity of long-term debt. March ending.
Current maturity around, I think, 35-36 crores.
Okay.
And let me check for you. The fuel cost is not. I will answer you. Just give me a minute. We will just check up in the accounts.
Thank you very much, sir. Fuel cost for the year and also for the quarter. And that's it from my side, sir. All the best. Stay safe, sir. And thank you very much for your great performance. Thank you.
Thank you.
Should we take the next question?
Yeah, please.
Thank you. The next question is from the line of Ashish from Toptal. Please go ahead.
Hello, sir. As for the last con call, you said a lot of imported fabrics are not coming in. Hence, you're getting increased demand for your product. So, any change in that? Because you said because of people not able to travel and trade issues are there. So, any relief on that front so that our demand for our products might be impacted?
No, that is continuing to be same. The imports are still very low. There is no change in that situation.
Again, and if you want to persist, the situation will persist. And if you
I think so. It will persist. See, once people get used to using local things, there is no need for them to import. No.
Okay. Thanks. That's all from me, sir. Thank you.
Thank you. The next question is from the line of Maulik from Equirus. Please go ahead.
Thanks for the opportunity and really very good set of numbers. Just a few questions.
Yeah, sorry.
Yeah. So one, I think on the export front, you mentioned that in this quarter you shipped around 10,000 ton compared to the 12,000 ton despite all the logistic challenge. And given the domestic market is very weak, is export as profitable or the profitability in export business is still good?
Normally exports are happening at the similar or slightly better profitability than India, the local market.
Okay. And given there is a weakness in the domestic market, and you mentioned that the raw material PTA and MEG prices are probably...
It's the domestic market, so we are trying if we can increase exports for the time being. But see, all over the world also this pandemic is creating problems, which are the major exporting countries like Brazil, Egypt, all these countries and Turkey, they are also having problems with the COVID. So the demand is low there also. But whatever best can be done, we are trying to do.
Okay. So in the last year in FY20, 15% of your revenue was from the export. And what could be the number this year? And we continue to maintain this range of whatever 15% for the export business?
See, this year the number was around 11%.
Okay. And just last question, that's again on the bookkeeping side. Can you give the average PTA and MEG prices for this quarter? And post-commissioning of this power plant, I think in an earlier con call you mentioned that you will have a saving of around 2 rupees at a unit level at the electricity cost. So that still remains the same?
Yeah, that remains more or less. Yes.
More or less. Because internationally the coal prices has also gone up.
You are asking about this quarter PTA prices, average was 54 rupees. MEG was 47.30.
Okay.
And what else in this quarter and which other?
And then I think you mentioned that there could be some inventory gain this quarter given there was an increase in a PT and MEG price. But that number might not be greater than the 10-15 CR.
Blended polymer cost was 62 rupees 52 paisa, which was around 48 rupees in the last quarter. So there is a gain of approximately 14 rupees increase in the raw material prices. So that would increase the stock value. So that's what I meant.
Okay, I got it. Thanks. I'm done.
Thank you. The next question is from the line of Aditya from B&K Securities. Please go ahead.
So thank you so much for the opportunity. I just have two questions. One is so as we know, the demand for cotton is largely coming from home textile segment and knitted segments. So for our business, which segment is exactly contributing to our demand? And second is you have said we'll be achieving margins which will be better than third quarter, which will be better than Q3's level. So what exactly are they sustainable for the near future, barring the near term shocks
Yeah. So margins better than Q3 are sustainable. And the demand overall has been good for all the textile sector, whether it has been upholstery or fabrics and everything. So everywhere the demand was quite good.
Okay. Okay, sir. Thank you, sir. That is from my side.
Aditya, do you have any follow-up questions?
No.
Thank you. The next question is from the line of Naidu, an individual investor. Please go ahead. Naidu, your line is in talk mode. May I request you to go ahead with your question? Due to no response, we move on to the next participant. The next question is from the line of Shri Shankar from InCred. Please go ahead.
Thank you. First of all, congratulations on a very good set of numbers, and you have continued to deliver as you promised earlier. I have three specific questions. The first question is, because the raw material prices are so much fluctuating, it's pretty difficult to look on a quarter-on-quarter basis in your gross margins. So what do you think is a more sustainable growth margin that you can have, given the product profile that you have over a longer period? Because if I look from last quarter of Q4 of FY20 to Q3, then Q4 of FY21, the gross margins the variation is quite huge, and that comes and hits your EBITDA also. And you've done very well. So what do you think is the average gross margin that you can have in the current product?
See, in our industry, you don't need to look at the margins as a percentage of the top line, because the top line, as you rightly said, it changed with the change in the raw material prices. So if you look at the EBITDA as a number, that is a better parameter to see the growth of the company and the ROCs and ROEs. So because the top line keeps changing with the prices of the raw material, and also sometimes we can vary the volumes with the same machinery depending on the season and the profitability. If from the same machine we can make 100 kg, same machine can also produce up to 200 kg in yarn. So that we have to take a decision seeing in the market and the margins. So the better way is to look at the EBITDA margins per se, not at the percentage or per kg. Sometimes if we produce chips more, then EBITDA per kg would also go down. So it's a better to look, even though it will be contributed some little bit to the EBITDA. So we have to produce to take that margin of 2-3% what we get on chips. So it's a better way to look at the absolute number of EBITDA.
That's the reason why, sir, I was mentioning that rather than looking at a quarterly number, would rather like to look at a full year number, because it probably takes away the volatility of...
Full year is okay. Full year is definitely a better barometer, because there are certain cyclic problems.
Yeah.
But otherwise, even if you look at quarter to quarter, if you look at the absolute EBITDA number, that would be much better than looking at a percentage of EBITDA on the top line.
So the second question was regarding, to a query that you mentioned that you probably will be commissioning the power plant by May. Is it right? So it was supposed to get commissioned this month, right? Now it's got postponed to May. And in your existing facility, how much of incremental capacity that you can add, or you will have to go for a new facility for your expansion program? That's the next question. And can you also spell out your Capex program, apart from that 175 crores that you mentioned, the pilot project that you had in terms of recycling project? Have you finalized on the place where it is going to come up and the project cost, etc.?
What was the first question? I initially said, please ask one question at a time. Again, you can ask the question only by the time you finish. Sorry.
Sorry.
What was the first question you said?
My first question was, what is the Capex program that you have?
Okay, I'll answer that, then you ask again. Okay. See, right now we have a Capex program of 175 crores to add 100 tons of POI and texturizing. And after this, I don't think we will have a spare capacity in this plant and the unit. And both these things will be coming in the same location. And anything further will have to go for a new location. And for further Capex, we have plans to put this recycling plant. There the Capex will be around 250 crores. But that will only start end of this calendar year.
Okay.
But then the most portion of that will happen in next financial year.
Okay. That's the recycling project is going to cost on 250 crores, correct?
Correct. So that will be recycling waste to chips and making chips to yarn.
Chips to yarn. And what's the capacity that we are speaking about?
We are thinking about putting around 100 tons per day.
100 tons per day.
Yeah.
Thank you. And congratulations again for a very good set of numbers and continuing to maintain it. All the best.
Thank you. Yeah.
Thank you.
I'll just answer the question with the one gentleman asked about the power and fuel cost. So this quarter our power cost was 57.7 crores and the year as a whole it was 167.6 crores. And the term loan current maturity is 37 crores. I think any other thing if I have left out, please let me know. I'll answer that.
Thank you. The next question is from the line of Madhukar, shareholder. Please go ahead.
Yes, I am Madhukar. My two questions. One is on power plant and second is on recycling. The power plant question is, what is now that you have commissioned, what is the final cost of the plant per megawatt?
The final cost would be around, this includes GST also, we'll be having a cost of around 165 crores for 30 megawatt.
165 crores for 30 megawatts. And what will be the cost of power?
Power running cost would be around 4 rupees to 4 rupees 10 paisa per unit.
Now this 4 rupees will contain how much cost of coal, how much finance and how much others?
No, this is no finance cost. This is coal and operating cost of manpower and certain additives and maintenance cost.
So coal cost will be how much?
Coal cost would be around 3 rupees 50 paisa.
So only 50 paisa is the balance cost.
Yeah, I am saying that is for operational cost, not interest or depreciation. Interest and depreciation is separate.
Okay, now where from the coal will come?
It will come from, there is a port in Dahej only, Adani. From there we have tied up for the coal.
It will be imported?
It will be all 100% imported.
What is the calorific value of the coal, average?
Depends what we feel which is the better price. We can use from 3,700 to 6,000, whatever we can.
3,700 to 6,000?
Yes.
But generally people use imported coal at least of 6,000. So the 37 would be waste to transportation.
We have to see which is the better cost per calorific value of the coal that we will use.
What will be the thermal efficiency of this plant?
I have no idea. I'll have to ask my people and let you know.
Please let me know. Now the second question is about the recycling. I understand that the recycled product cannot be better than the original product. Is it true?
No, it is not. It can be similar to the recycled product, the original product.
Sir, so far the recycled product prices were about 20% lower than the new product.
I think you didn't follow. We are doing a chemical recycling where we will be converting the waste back to raw material state and then cleaning all the impurities and then converting back to the polyester. So it will be as good as a virgin polyester. We will be not using the polyester waste directly, just melting and using it, what people are doing now. We will be depolymerizing it. Means taking it back to its original raw material forms and then taking out all the impurities from there and then again polymerizing it. So this technology is very, very recent and very few people involved are doing it and at a very, very small scale. This is a new technology which people are developing. We are also in the developing stage of this technology.
Sir, only one producer in Ganesh Poly which is trying this technology.
Ganesh Poly is doing mechanical recycling. They are just washing the flakes, melting them and using them. They are not depolymerizing.
Yeah, but they are trying and not succeeding.
I cannot comment on that.
Very true. Now, sir, the advantage they see in recycling is that the government has passed some order or some resolution that those who want to make fresh bottles of PET will have to take certificate of recycle. And that can fetch about 10 rupees a kilo for giving certificate if you are producing a recycled material.
I know, but what we will be producing a recycled yarn. At the moment, a few companies whoever are doing are getting a margin of 60 to 70 rupees kg over and above the virgin.
So that is because some of the Western country people are trying to encourage the recycling.
Right.
That may not happen in India. In India, nobody is worried about recycling.
No, but they are sourcing all their products from India and Far East countries only. They are not producing any garments. They are sourcing all these from countries like us only. And there is a shortage of recycled filament yarn and fiber available through chemical recycling. So it is not available the volume which they want. And they have targets to go up to 50% by 2025. Maybe now they will change that target because of COVID. But there is a very big demand of this product.
So Ganesh Poly has been recycling and has not got any premium so far on the...
Sir, you are not able to understand. I cannot say again.
Sir,
they are doing chemical recycling. And we are talking about chemical recycling. Why are you comparing Ganesh with us? We have not started as yet. Once we start, then you will know. There is a company like Polyester in India which is doing, and they are fetching a premium of 60 to 70 rupees. You can ask them. I am not talking something which is not happening. There are companies in the world who are already trying to do this. There is a loop industry. There is a cargo. There are a lot of companies. You do a research, then tell me. No, you have not done anything. You are just talking about Ganesh. Ganesh is doing a mechanical recycling. I have told you again and again.
No, I only thought of talking about the recycle price and the original price. Okay, I take
recycle. This product is not available in the market. Only Polygenta is making in India, and they are getting a premium of 60 to 70 rupees per kg.
The second thing, about 3, 4, 5 years back, the resolution was passed to ask all PET users to get the certificate of recycle. There is
no such resolution by the government as of now.
Okay, thank you.
Thank you. Next question is from the line of Sonal Minhas from Prescient Capital Ventures. Please go ahead.
Hi there, this is Sonal Minhas. I hope I'm audible. I have two questions.
Yeah.
One is,
please go ahead.
So the first question is with regard to what has been happening in the last 2 to 3 quarters in terms of better realization, and which is basically tuning into margins. Typically, we've seen industries where such kind of, let's say, you could say a structural shift in demand supply happens. People start adding capacities. There is a little bit of challenge in terms of competition coming in. So I have two parts to this question. One is that how are you seeing your competitors behaving? Is there enough for everyone to chew in terms of demand? I'll pause here. I just want to know how is competition behaving vis-a-vis you. I just want to get a holistic picture there, and then I'll ask the second question after you answer.
Thank you. See, as far as competition is there, we are basically 5 or 6 major players in this industry.
Mm-hmm.
And to name a few, Bilosa is there, Well-Known is there, we are there, Alok was there, who has been taken over by Reliance. Reliance, of course, is the biggest. Mm-hmm. And then Sanatan is there, Sublakshmi is there. These are the major players. Right now, there is no major expansion happening. Only one capacity will get added in the next year, mid of next year, which was wiped out in FY20 February. There was a fire in one of the plants. So that capacity was wiped out. So he has ordered some machines which will be getting commissioned by next calendar year. Other than that, nobody has taken up any expansion plan as of now. And whatever people would decide would also take at least 2.5 years, because the availability of raw material is also scarce in India at that time. Like PTA, we don't have enough PTA for new expansion. Already we are neck to neck in the capacities. MEG, of course, we are importing. MEG doesn't matter. It's a small compared to PTA. And also China is also importing MEG from Middle East, and we get a better price from Middle East. So that's not a problem. But PTA plants are a problem. And the first PTA plant expected is in FY24. Reliance has not announced yet, but I think they are also planning to put up a PTA plant, which will get commissioned in calendar year 24. And also in calendar year 24, IOC is also coming, Indian Oil is coming with a PTA plant in Paradeep.
Okay.
So I think most of the capacities people would plan would be in line with these PTA plants. see when these will be available, because it's very difficult to import such huge volumes and keep the plants running. Local availability is not there now at the moment.
Not there, I understand. So, sir, when you talk about like structural change in pricing and in margins, and you say that Q3 margins will hold largely a little higher than that, is the timeline for that linked to capacity coming in 24, 25, or because you said in the last call?
I don't think so. See, it's my belief that even the capacities which come in will not hamper, because first of all, in next 3 years we'll have a decent growth. Normally the growth in the industry has been around 9%. And we should have more growth because now the government is focusing on man-made fibers for downstream, and they have put a lot of restriction. Even China, where they are exporting, the margins they have increased. And internationally, the demand is rising by almost 3 million tons every year.
Okay.
So I don't think we should have a problem. Even if the 2 or 3 plants come up, they will not even add up to more than 600,000-700,000 tons. So today the volumes which we are doing as an industry would be around 4.2 to 4.4 million tons. So in 3 years we would need more than 1 million tons more. And I don't think more than 1 million tons would come up in next 3 years.
Got it. And typically, sir, you know your competition well. In this one, like how do people behave in terms of pricing discipline given when capacities come? Do people dump, or do people because they have to service debt? Just trying to understand.
No. See, now it's an international market. Even if this price come, then gets padded by exports. Of course, there can be a slight reduction in the margin, but then people start exporting more.
Got it. Okay. So you have better
big issues in that. And a lot of downstream machines are also coming, because in fabric and garments, a lot of machines are getting imported because they have also enjoyed good margins, and those machines, and they have the raw materials available. So there the expansion is much more rapid than what will be happening in the yarn market.
Okay, so that will basically provide a cushion to whatever.
So we'll have better demand than what we will be able to supply.
Got it, sir. So last 1 to 2 years, I think whatever I've been reading in the calls, you said that you are moving towards value add / the brighter yarns, if you say, and the realizations are higher. So, what is the mix right now as we speak? And
right now, you see, barring chips, we have reduced our POI also quite a bit. So most of the things we are converting to value added, and whatever is left in this next 1 year, we plan to convert almost everything to value added. There might be very small volumes left.
Got it. And that is structural. So let's say this is not opportunity led, that this year this can happen this way and next year the mix may become 50-50 or whatever because of the demand.
No. Once we have put a capacity, it will always remain. So we will be making only value added only. Value added we mean is DTY and FDY. Those are more value added because they directly go for making the fabric. There is no more process of the yarn to be done. And there you have a vast market, international as well as whole of India. If you make POI, you are confined to very few buyers, and chips maybe lesser buyers.
Got it. So that is like the structural shift, and hence that gives you the confidence that the margins, the company is entering a different margin profile from a longer term perspective. Got it, sir. Sir, a follow-on question on this one. Been seeing that your return on capital is structurally going up, but we've been adding capacity year on year. So you can just look at the free cash flows that you've been generating, and this is more for us as minority shareholders trying to understand. Do we expect the company to generate free cash flows net of Capex from the coming year onwards?
Yes. No, we will. Last year also we generated free cash flow net of Capex and reduction in debt also.
So I was talking more
every year we will be doing that, and as deemed fit, we will suitably reward the shareholders with that money.
Okay, sir. Just the last question, sir. The pledge on the stock, I think just wanted to understand what is your longer term plan around that?
I think in this year we will be able to release the pledge. See, basically this pledge is not a borrowing we have done. These have been taken by the banks as a collateral against the term loans and
yes.
Yeah. So now our debt equity and our current ratios all have improved significantly. We can ask the bankers to please release our pledges.
Got it.
Or we will be maybe in a position to repay all their rupee loans. Or maybe we'll switch the banks if they don't agree.
Got it. So if you were not doing any new capex, the debt could have come down to zero post this quarter. Like I'm assuming that, or that you would keep some debt on the books still.
No, we will keep some debts on the book, like ECBs we will keep on the books. We will try to first reduce the rupee debt. And in the new venture, like for texturizing, we might take debt because we will get subsidies on that. So wherever we feel we get a benefit by taking a debt, we'll take that, but we can reduce our already existing rupee debt from the money left. So overall debt will go down. That I can assure you in this year.
Okay. And sir, if I could just squeeze in a last question regarding what you see this quarter. I understand, I think it's not in anybody's...
It's very difficult to answer seeing the today's situation.
Yes. No, I understand that, not even, I think, pinpointing anything on that. Just understanding that, like, the preparedness of the company for, let's say, the ramp down in production, what has been like the learning in the last 1 year, and how do you plan to enforce that?
Last year what happened was the raw material also prices fell, no? Because there was a total chaos in the world which happened. This time you will see there's not much chaos in the world, even though the numbers are rising.
Yes.
So all commodity prices are all still stagnant or rising. So we don't feel that even if whatever best we can do and store the material to the extent possible, we will run the plants. See, last time the government forced us to close the plants at least for 6-7 weeks, and then the labor also went away 100%. Now labor is going, but still we have enough labor to run at decent capacity. It's not that all the laborers are running away, and some are coming back also. Some had gone to UP for elections and also they are coming back also. And I think by May end labor starts coming back.
Yes. Fair enough, sir. Thanks a lot. These are my questions. Thanks a lot, sir. Thank you, sir.
Thank you very much. The next question is from the line of Anik Mitra from Filatex Research and Advisory. Please go ahead.
Good evening, sir. Congratulations for good set of numbers. Sir, my question is, sir, there is like globally, MMF and cotton ratio is somewhere around 72:28, what I got from Textile Ministry's data.
Right.
Sir, in India, cotton has more weightage. Sir, how much further room you are anticipating in favor of MMF, and like how the MMF can replace, or up to what extent MMF can replace cotton in India going forward?
See, first of all, MMF is not replacing cotton. What is happening is the incremental growth is all coming from MMF because the availability of cotton worldwide is reducing. So that is why it is happening. Right now in India, I think the ratio is 55% to MMF and 45% natural. As the growth in India would happen, the MMF share automatically will increase because there is no scope to increase the natural fibers. So that is what is happening. Also, the quality of MMF has been improved considerably. Now, all wears you will not even come to know whether MMF is there or not. All your sportswear are now 100% MMF. So that's one example I'm just giving. So now MMF is a dominant fiber, and also see, MMF is less polluting. People feel MMF is very polluting. But to make cotton to yarn and then yarn to fabric and garment, there is a lot of energy, water usage compared to what is used in MMF.
Okay.
Dyes, chemicals which are used to make for cotton require a lot of water and everything. Now in MMF we can do dope dyed also, where there is no water requirement. We put colors while making the yarn. So all those features now are in favor of MMF, and people are using more of MMF because polyester filament is also cheaper than all the natural fibers. It is almost less than 50% the cost of MMF, the natural fibers.
Okay. You told 65% is MMF and 35% in India.
No, 55 and 45.
55 and 45. Okay.
Yeah, global, like you said, is 69 and 31, but in India it is around 55 and 45.
Okay. Still, you are saying in India also it is in favor of MMF.
Yeah, see, because the new requirement cannot be met by cotton, no?
Okay.
There is no availability of cotton more than a certain volume.
Okay. Okay. Mm-hmm.
So the new requirement is being met by polyester and other man-made fibers. Okay. And polyester is almost like 80% of the man-made fibers.
Okay. Yeah. Okay. Got your point. So my next question is the PLI scheme. Like how much benefit we can reap in terms of polyester and all from.
It has not been announced as yet. And whatever we know and whatever has been told, they are bringing it for garments made out of man-made fibers and technical textiles. So there are certain chapters they have included, and most of the chapters, I think around 30 chapters, are of garments made out of man-made fiber, and around 10 chapters for technical textiles. That is what is there till now. If there are some changes, we don't know, because the scheme has yet to be announced.
Okay.
In textiles.
In any time frame you are anticipating for the announcement of PLI scheme?
I think it should happen within this quarter or sooner. Because they are almost ready with it. I don't know why they are delaying.
Okay.
Yeah.
Okay. That's great. Okay, sir. Thank you so much. Thanks for answering my question. Thanks. Yeah.
Thank you. The next question is from the line of Dipesh from Manya Finance. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir, go ahead.
Yes, please go ahead.
Yeah. First of all, congratulations on having such great results. And also, I would like to show my appreciation to the management for purchasing shares from the open market because it builds investor confidence. Now, the first question to ask is about the interest cost. The interest cost in this quarter was quite low, around 6 crores. Going forward, do we see this kind of interest cost or maybe lower? Or, annually, do we look at 25 crore of interest cost?
No. This quarter it was lower because we have some ECBs in Europe. So the rupee has appreciated against euro in this quarter. That's why it is lower. But I think year as a whole, I don't see this number. We will see slightly lower than the whole year numbers, but not these numbers.
What is
hello?
Hello.
Sir, sorry,
Yeah.
I'm not able to hear you properly. Can I request?
Am I audible right now?
Yes.
Yeah, I just want to know that going forward, reduction of interest cost you see.
We will have some reduction in the interest cost, what we had in this year. So whatever we have repaid the rupee loan, that will be reflected in the interest cost. But it will not be to the tune of this quarter. So it will be like maybe around 8-10 crore rupees lower than what we have had in this full year.
Okay. Fine. My next question is about the capacity addition. The captive which is coming, when is it getting commissioned? Which quarter?
The captive power plant?
No, not the captive power plant. The capacity addition in the...
capacity, we yet to start that, and that will get commissioned in FY23 first quarter. We have not just started anything. We have not started spending anything on that. We just started taking up and inquiries with the suppliers, and everything is going on.
Okay. So,
Dipesh, sorry once again, but again your voice is breaking. Can I request you to
It's cracking.
area?
Am I audible right now? Can you hear me?
Yeah. Yes.
Okay. I'm asking that the major addition in capacity will be polyester sheet and POY semi-dull.
It will be a combination of bright and semi-dull POY and texturizing. And texturizing also will be putting normal texturizing and also some air texturizing.
So are these products a higher margin?
Yes, definitely air texturizing has a higher margin than a normal texturizing.
Okay.
Air texturizing is a yarn where you have some slubs in that and fancy yarns. So that also we will be putting now.
Okay. And how does the product prices get affected?
Sorry, not audible.
Hello?
Yes, now it's better.
Yeah. Want to know that how does our product pricing get affected from the crude oil prices? Is it directly proportional?
Not directly, but indirectly, of course, it gets affected because raw material prices have some effect of crude.
Okay. And with cotton prices increasing, will that have only an effect on people more?
See, cotton is a very different thing because cotton prices are more than double our pricing. Whether their price increase little bit or decrease doesn't affect the polyester market.
Okay.
They have a different market and different customer for cotton. A cotton customer will not use synthetic just because of the price.
Now, this last question, you mentioned that depolarizing of recycled goods will get you a premium of 60 to 70 rupees over the virgin polyester. Am I right in understanding that?
As of now, people who are producing whatever niche chemically recycled yarn, they are getting a premium of 60 to 70. What I will get when I come into the market is difficult, but I feel that we should be able to get at least 30-40 rupees, even though that will also be a very decent margin because our cost of production will not be more than the virgin. So whatever the margin virgin is getting, over and above that, even if we get 30-40 rupees, it is a very huge margin.
And what are the virgin prices right now?
Right now, prices are in the vicinity of around 90-95 rupees. Depending on product.
So that's approximately 30 to 35%, even if you consider the 30-40 rupees we get. So that will be approximately 30 to 40% premium.
We will definitely get a 30% premium or 40% premium.
When do we plan to start this, sir?
It will take at least 2 years from now.
2 years from now. Great. We will be there with you. Thank you so much.
Thank you. The next question is from the line of Manish from Camelot Ventures. Please go ahead. Manish, may I request you to unmute your line from your side and go ahead with your question? Manish from Camelot Ventures, may I request you to unmute your line from your side and go ahead with your question? Due to no response, we move on to the next participant. The next question is from the line of Neeraj from White Pine Investment. Please go ahead.
So this is Neeraj Martinga. I just wanted to know what is the gross margin for the yarn in Q3 for the POY and DTY yarns?
In Q3?
Yeah, Q3 and Q4. That's one.
I can give you a very approximate because there's a lot of. I think in Q3 we were getting in POY around maybe 10 to 12 rupees. And which other product you were saying? Sorry.
POY, DTY, and FDY.
Okay. So POY could be 10 to 12, DTY would be around 15 to 17, and FDY was the major, which was like 35 rupees. And Q4 POY would be, you can add another 5 rupees to all these three, something like that.
Okay. So in that way, the DTY is contributing a large contribution to your margin today. So and
DTY basically DTY is a combination of POY and DTY both margins, no? Because you make POY and then do DTY, the same product.
Sorry, I asked the wrong question. But FTY was adding a lot of margin to you.
Yeah.
So
FTY was doing the very, very, very good in both the quarters.
So do you see this continuing over some period, or is there any reason it should change?
I think what we have done in Q3 in FDY would be sustainable, not maybe in Q4. And we could have do better than what we did in POI and DTY in Q3. So there we might have a slight increase in the margin. But in FDY, we should be able to do what we did in Q3.
Okay. Got it. And the capacity that you are planning to add of 100 tons per day in the texturizing the POY, do you have some breakup of that capacity, or is it just? No.
It's on a drawing board set. No breakup. It will be approximately 100 tons. It could be 110, 105, whatever.
Okay. And is it right to say that broadly till March 22, most of the Capex will be for the power plant and the capacity expansion and not on the polyester?
Power plant, the Capex has already happened. It will get commissioned only by end of this month or first week of May, early May. So the Capex for that has already happened. Now the Capex will be for this 100 tons of POI and DTY which will be putting. So that will happen in this year and first quarter next year.
Got it. So basically, all that, if I see from a cash flow perspective, your cash flow will mostly
we will have like 175 crores of outgo for the Capex. Maybe we will take some loans because we will get benefits from central and state governments for putting texturizing. So to the tune of that, maybe around 40-50 crores we take it as a loan, and rest would be out of our existing internal approvals. And if we import machines from Germany for POI, then we might take a ECB and repay our rupee loans to that extent.
Got it. Thank you very much. Yeah.
Thank you. The next question is from the line of Manish from Camelot Ventures. Please go ahead.
Good evening, sir. Heartiest congratulations on lovely set of numbers. Just to understand, like there have been a lot of questions regarding the sustainability of the business. First of all, I'd like to congratulate you. You have transformed the business by making more value-added products and adding more lines to that. So that makes the business really sustainable. Just to understand it little more, like you told, the Q4 numbers had one-time inventory profit. So barring that, the other numbers that you have, the profitability and the margins in the Q4, what we can understand from your conversation is clearly sustainable for the next year also. So in addition to that, in the next year, if you will not have the inventory profit, you will have the power gain. So that will compensate that. So overall, we can look at the numbers of Q4 in the next year to be same as like Q4. Is that understanding correct?
No, that will be too much. I think we will have something better than Q3, plus you can add the profits what we will get from power. I would just keep it at that level because there's a huge difference between Q3 and Q4 numbers. So I would not like to comment on absolute numbers, but it will be better than Q3, and then you can add power profit.
Okay. So basically what we want to understand, sir, the numbers are sustainable. It's not the one-off gain.
No, these are not one-off. Once the COVID situation improves, we can sustain margins which will be much better than Q3 for sure.
And in the COVID situation also, as you have told, clearly mentioned that you are continuing with the production. And once in the month of June, if the situation improves, you can sell the material. So there will be actually no impact of COVID if the situation improves gradually by June.
There would be some impact of COVID because right now the margins have gone down because there is less demand. Everybody wants to offload product. So I can't say Q1 what will it be, but definitely we will have a decent Q1, but not maybe. I can't say when this situation of COVID will improve. It's a difficult question to answer.
Yes, but clearly the margins are sustainable.
Yeah, margins are sustainable. Let's say if the COVID situation improves, I think within a month we can be back to Q3 margins. This is what I can say.
Okay. Thank you, sir. That's all for me.
Thank you.
Thank you. The next question is from the line of Ridhima Chandak from Roha Asset Managers. Please go ahead.
Thank you for the opportunity, sir. Just one question from my side, that what are the spreads we are seeing in the last 1 year, spread changes?
The spreads have changed significantly in this year because after COVID we had a very, very low spread. We were barely able to cover our cost and not even maximum interest cost. And then after Q2, things have started improving. From August end, things started improving. So they have been improving till February end. And then March, it was a little down. And then because of COVID, then half of March, things started going down. So it's difficult to answer. I can just give you a vague, how it has happened. The numbers, it's difficult to give any numbers for this period.
Okay.
But the margins have been improving from September till February.
Okay. So means like earlier in the last call, it used to be, you said that it was 20 rupees per kg, and in Q3 it was approximately 25, increased to 25. So is there any significant change in this spread or?
Q4 has been significantly better than Q3 for sure. But what I'm saying in margins slightly better than Q3 are sustainable. The Q4 there is a lot of stock profit also.
Okay. And sir, another is in the quarter 3, selling price increased by almost 16 rupees per kg, whereas raw material price have increased almost 10-11 rupees per kg. So there's gain on the margins by 4 to 5. So how much it is in the quarter 4?
Quarter 4 also we have had around 4 rupees gain over and above the increase in the raw material prices.
Okay. So there is not much increase in the selling price increase more than the raw material prices.
Yeah, it has increased more than that.
So if you can quantify how much it is, how much we have increased our prices in the quarter.
I don't have those numbers right now. I would share with you once we calculate those numbers.
Okay, fine, sir. Thank you so much.
Thank you. The next question is from the line of Jigar Walia from OHM Group. Please go ahead.
Hey, congratulations and thanks for the opportunity. My question is with regards to Bilosa, what was the capacity earlier? What is the capacity which is coming next calendar year? And
See, yarn, they have fiber also. So they have around 450 tons per day of fiber. And before the fire, I think they had a capacity of roughly around 2,300 tons of yarn, filament yarn. And their capacity of 700 tons was wiped out in this fire. And now they are bringing back that capacity back on trail. So I think next year, mid next year, they should have that 700, 750 tons back. I don't know exact what they have ordered, but it will be minimum 700, could be 50 tons or 100 tons more.
Understood. And your sense in terms of value add versus basic mix for Bilosa and the new expansion?
Bilosa is in total value add. They don't do any POI or chips mostly. Right now they are doing chips because their capacity of yarn had wiped out and the chips capacity is still there. So they are doing chips. Otherwise, Bilosa is doing 100% value add.
Understood. Thank you so much. Thank you. Congrats.
Thank you. The next question is from the line of Jay Mehta from KSA Shares and Securities. Please go ahead.
Hello. Congratulations on excellent set of numbers, sir. Sir, most of my questions are answered. I just have one question, that is regarding the geographical sales split. If you can just give a number. Last year we had an export of 397 crores, if I'm not wrong. What would be this year number?
Yeah. This year we had export sales of 242 crores, year as a whole. Hello? Hello? Hello?
Jay Mehta, may I request to unmute your line from your side, please?
Hello? Can you hear us?
Hello.
Hello?
Can you hear us?
Hello.
Now we can hear you, yes.
Yes, sir. Thank you. That's it from my side. All the best.
Okay.
Thank you very much. Ladies and gentlemen, due to time constraint, that will be the last question for today. I will now hand the conference over to Mr. Madhusudan Bagaria for closing comments.
I'd like to thank all the participants for sparing their time and joining us for our con call. Thank you very much. Have a good day and a safe day. Thank you. Bye.
Thank you very much. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.